What if I told you the difference between dying broke and retiring wealthy isn't your salary, your education, or even your intelligence? It's five simple rules that a 19-year-old Warren Buffett discovered in a dusty old book. Rules so powerful, they turned a young man from Omaha into the world's greatest investor. Rules that Benjamin Graham laid out in The Intelligent Investor, the book Buffett calls the best investment book ever written. Today, I'm breaking down these five game changing principles that will completely transform how you think about money, risk, and building real wealth. Stick around, because what you learn in the next few minutes could save you decades of financial mistakes. Rule number one: Mr. Market is your servant, not your master. Let's start with the most brilliant concept in the entire book, one that most people completely misunderstand. Picture this: you own a successful family restaurant. Nothing fancy, but it's packed every night. Loyal customers, consistent profits. You built something real. Now imagine every single morning, this unhinged neighbor, let's call him Mr. Market, bursts through your doors with a wild new offer to buy your restaurant. Monday morning, I'll give you $2 million for this place. Restaurants are the hottest thing right now. Tuesday, he stumbles in looking defeated. Restaurants are finished, man. Food delivery killed everything. I'll give you $100,000. Take it before it's worthless. Wednesday, he's back with manic energy. Never mind. I changed my mind. $1.5 million. Restaurants are cool again. This goes on every single day. Here's the $1 million question. Would you take this lunatic seriously? Of course not. You'd probably call security. But here's what's crazy. When it comes to the stock market, people treat Mr. Market like he's some kind of financial oracle. Stock prices go up. I'm a genius. Time to buy more. Stock prices drop. The world is ending. Sell everything. Why do we do this? Because the market looks official. It's on Bloomberg. It's got fancy charts. It feels legitimate. But Graham's point is simple. Mr. Market is just as irrational as that crazy neighbor. He's driven by pure emotion, fear and greed, nothing more. Think about March 2020. The pandemic hit, and Mr. Market had a complete meltdown. Suddenly, Apple, Microsoft, Amazon, companies that were printing money, were trading at massive discounts. Did these companies become terrible businesses overnight? Number Mr. Market was just having his daily mental breakdown. The smart investors? They didn't panic. They saw Mr. Market's tantrum as a massive opportunity. While everyone else was selling, they were buying world-class businesses at garage sale prices. Graham's golden rule: the market is there to serve you, not to instruct you. Your job isn't to predict where prices go next week. Your job is to understand what you own and only act when it makes sense. Use Mr. Market's mood swings to your advantage. Don't let them control you. Rule number two: stop gambling and start investing. Here's something that'll blow your mind. Most people think they're investing when they're actually just gambling with better marketing. Real investing is like buying that restaurant I mentioned earlier, but only after you've walked through the kitchen, checked the books, met the staff, tasted the food, and studied the neighborhood. You're buying because you believe in the business, not because your buddy told you restaurants are hot right now. Speculation? That's like buying a restaurant sight unseen because someone on TikTok said it's going to the moon. You have no idea what they serve, if they even have customers, or if the place is about to be condemned. You're just hoping someone else will pay more tomorrow. Graham breaks down real investing into three simple requirements. You do thorough research, you protect your capital, you expect reasonable returns, not get-rich-quick fantasies. Let me paint you a picture. The late 90s dot-com bubble. People were throwing money at anything with .com in the name. Didn't matter if the company had zero revenue, zero profits, zero chance of survival. If it was on the internet, money poured in like water. What happened? Reality hit like a freight train. Trillions of dollars evaporated because people weren't investing. They were speculating on pure hype. Here's Graham's reality check. When you buy a stock, you're not buying a ticker symbol or a lottery ticket. You're buying actual ownership in a real business with real employees, real products, real revenue, good months and bad months, just like any business. So before you buy anything, ask yourself, if I had to own this entire business for the next 10 years, would I be happy? If you can't answer that confidently, you're not investing. You're gambling. Investing might be boring sometimes, but boring builds generational wealth. Speculation just builds screenshots of your account right before it crashes. Rule number 3, never pay full price. The margin of safety. This might be the smartest thing Benjamin Graham ever taught, and it's criminally underused by most investors. Here's the core principle. No matter how brilliant you are, no matter how much research you do, things can go sideways. The economy can tank. Companies can screw up. Mr. Market can panic for no reason. You need a buffer. You need room for error. Think of it like engineering. If you're building a bridge for 20,000-pound trucks, do you build it to handle exactly 20,000 pounds? Hell no. You build it for 50,000 pounds minimum. That extra capacity is your safety margin, your protection against the unexpected. Same principle with stocks. Let's say you calculate a company is worth $100 per share through careful analysis. Are you buying at $100? Not even at $90. You wait until it hits $60 or lower. That $40 gap is your margin of safety, your protection against being wrong. Look at 2008. The financial crisis hit, and panic selling drove incredible companies like Coca-Cola, Johnson & Johnson, and Walmart to ridiculously low prices. Not because they became bad businesses, but because Mr. Market was having his biggest meltdown in decades. Warren Buffett went shopping. Why? Massive margin of safety. He wasn't gambling on a recovery. He was buying dollar bills for 50 cents. But here's what people always ask. What if I love a company but the stock keeps going higher? Great question. Let's say you're obsessed with a restaurant chain. You've studied everything, their menu, locations, financials, management, but the stock keeps climbing. It's tempting to jump in because of FOMO. Don't. A great business at the wrong price is still a terrible investment. If it's overpriced today, you don't chase. You stay patient. Add it to your watch list. Study the business, not just the stock price. Wait for Mr. Market to have one of his inevitable breakdowns. And trust me, he will. Buffett said it perfectly. The stock market is designed to transfer money from the impatient to the patient. Your edge isn't just knowing what to buy, it's knowing when to buy. Wait for that price where you've got room for error, where the risk is minimal and the upside is massive. Rule number 4, pick your lane and stay in it. This next principle will save you years of confusion and costly mistakes. Graham was crystal clear. You're either a defensive investor or an enterprising investor. There's no middle ground, and trying to play both will destroy you. Think of 2 different types of gym goers. The first person shows up 3 times a week, does some cardio, lifts some moderate weights, stays consistent. They're not trying to win bodybuilding competitions. They just want to stay healthy and avoid injury. That's your defensive investor. The second person has a detailed workout plan, tracks every rep, meal preps religiously, studies exercise science. They want serious results, and they're willing to put in serious work. That's your enterprising investor. Both approaches work beautifully, as long as you know which one you are. If you're defensive, here's your playbook. Don't chase individual stocks. Don't try to time the market. Don't treat financial news like breaking alerts. Buy broad, diversified index funds like the S&P 500. Maybe add some bonds based on your age. Invest the same amount every month, whether markets are up, down, or sideways. That's dollar cost averaging. Check your portfolio once or twice a year. Rebalance if needed. Then let compound interest work its magic. This is how most people should invest, and it's how most millionaires actually got rich. But if you're wired differently, if you genuinely love reading annual reports, analyzing financial statements, hunting for undervalued businesses like a detective, then go enterprising. That's what young Warren Buffett did. But understand, it's serious work. We're talking hours of research, constant learning, disciplined analysis. Graham's warning is crucial. If you don't have the time, skill, or genuine interest to research properly, stay defensive. If you're obsessed, disciplined, and willing to outwork everyone else, go enterprising. But never try to play in the middle. That's where people get destroyed. They end up chasing hot tips, buying high, selling low, panicking during every market hiccup. That's how people lose money and confidence. Pick your lane, master it. Ignore everything else. Rule number 5, master your emotions, or they'll master you. Let's address the elephant in the room. Your biggest enemy in investing isn't market crashes, bad companies, or economic recessions. It's the person staring back at you in the mirror. Benjamin Graham was brutal about this truth. The difference between successful investors and broke ones isn't intelligence. It's emotional discipline. We've all witnessed this disaster in real time. Market drops 10%. Suddenly, everyone's acting like it's the apocalypse. People start panic selling everything. Oh no, my portfolio's down. But wait, wasn't it up 50% last year? Or the opposite extreme? Some random stock explodes 200% overnight. Memes flood social media. Everyone's posting gain screenshots. What happens? Greed kicks in. FOMO. Maybe I should throw my life savings at this too. Look at history. Markets crash, recover, crash again. Dot-com bubble in 2000. Financial crisis in 2008. COVID panic in 2020. Every single time, some people panic and sell everything at the bottom. Others stay calm. Keep buying quality businesses. Ignore the noise. Guess who's richer a few years later? It's not about predicting the future. It's about keeping your head when everyone else is losing theirs. Here's the harsh reality. Markets will go up. Markets will go down. Sometimes for reasons that make perfect sense. Sometimes for reasons that are completely insane. Your job isn't to control the market. Your job is to control yourself. How do you build this discipline? Have a system. Use dollar cost averaging. Rebalance regularly. Stick to your plan no matter what. When you have rules, you don't make decisions based on panic or hype. Think of it like flying through turbulence. The pilot doesn't start yanking the controls because of some bumpy air. They follow their training, trust their instruments, stay the course. Same principle with investing. Master your emotions, and you've solved 90% of the investing puzzle. Putting it all together. These 5 rules work like parts of a perfectly designed machine. They're most powerful when used together. Start by treating every stock like you're buying the entire business. Ask yourself, would I be happy owning this for 10 years, even if the price didn't move? If not, walk away. Protect yourself with margin of safety. Don't chase stocks when they're running hot. Be patient. Wait for prices that give you a cushion, not a heart attack. When Mr. Market throws his daily tantrum, don't join the circus. Let others panic while you stay calm. Sometimes the best move is doing absolutely nothing. Know who you are. If you don't want to research individual companies, stick with index funds. If you love deep analysis, go for it. Just commit fully. Don't waste time floating in the middle. Finally, master your emotions. This is the foundation that holds everything together. Without discipline, none of these other rules matter. Build habits that make smart decisions automatic. Dollar cost averaging, regular rebalancing, ignoring financial noise. Do this consistently, and you'll protect yourself from your own worst impulses and from market madness. That's how you turn these principles into real wealth. The Intelligent Investor is packed with insights we barely scratched today. If you want me to dive deeper into Graham's other game-changing concepts, let me know in the comments. And if this helped shift your thinking about money, smash that like button and subscribe for more content that could change your financial future.